Hello everyone, welcome to Officer 24/7. My name is Niharika Bhatnagar and I'm with you with the specific area of our concepts of accounting show. And this is what we are covering in our classes, that is accounting and financial management for bankers. And the topic for today is derivatives. Everyone, you are on our YouTube channel JAIIB CAIIB English Medium. So first of all, to before I continue further, please share the session, like the session, and subscribe to the channel right away if you haven't done it yet. Okay, now let's talk about something called derivatives today. Derivatives is a topic which covers covered in our module C overall. And when we talk about the term derivatives, derivatives is the funds that we have in the organization. It's a kind of speculation, everyone. When we talk about derivatives, this is basically a gamble. If the price goes up, price goes down, that is what they look forward to. And this is for something which is notional in nature. I can sit with you and talk about the security pricing going up or down, the and maybe I won't even buy that security, but yes, I will anticipate the price, you will anticipate the price. Whosoever wins gets the money, the one who doesn't really has a loss. Kind of a betting, right? But in a very sophisticated and based upon the financial securities and backed up by the financial structure of the world altogether. That's how we look forward to it. So these are derivatives or financial contracts. These are basically what? These are financial contracts which whose value is derived from an underlying asset. That means you'll have that asset, maybe you won't. But the value of your security or the derivative is derived from that particular thing from which you the particular security that you are betting upon. That is what we can say. That is called your underlying asset. Okay, the investors to they allow investors to speculate. What do you mean by speculate, everyone? Speculation means the price going up or price going down. Okay, in terms of the underlying assets. Derivatives are versatile tools used by individuals, business, and even financial institutions. So this can be used by any of these organizations for their hedging, speculation, and arbitrage. Hedging means you are too scared about the future, then hedging then is like this speculation. Price goes up, you have a benefit. Price goes down, that is a loss. And the last is arbitrage. Arbitrage is basically when two markets are definitely not in a sync there. Then what do we do? If the two markets are not in sync, then there is one particular basic thing that we can do is we will um, we will buy thing from a market where the price is lower and sell it to a market where the price is higher. That is how we define the term derivatives. Let's continue further, everyone. There are different types of derivatives. There are the different types of derivatives. Okay, look at this part. Number one is futures. Number two, forwards. Number three, options. Number four, swaps. Futures and forwards are basically the contracts which I can say they are futuristic in nature. Hanji. So when we talk about the specific area of futures and forwards, the difference between the two is futures can be defined as when you will be buying the particular securities but not today, when you will be selling the particular securities again but not today. In this case, you will be doing it at a future time, that is a predetermined price on a future date. And when we talk about the forwards, they are also similar, but they are customizable agreements. Matlab, when you are doing through the regulatory market, then it is futures. When this is between two parties and they define what they want to do, what they want to sell, at what point of the time they want to sell or buy, all those things are considered in terms of forwards. Then comes options. Options are basically the contract between the buyer or the seller where you have the right, not an obligation. Matlab, you can choose whether you want to sell or not, whether you want to purchase or not. This is again futuristic, but whether you want to purchase in future or not, that's your call. And the last one is swaps. Swaps is basically if I have dollar and you have rupees, and both of us needs the other way around. We need the particular profit or loss for the other way thing, है ना? So that is what we look forward to, and then that is called swaps. मतलब you exchange the two different currencies. So exchanging the cash flows based on two different current underlying assets such as interest rate or currencies. If I have a floating rate, you have a fixed rate, we can actually swap as well. Swap, or we can say we can exchange. That is how we define the specific area of swaps. Done, everyone. Let's move on. Hanji, let's continue further. In this case, the next part is future contracts. Future contracts are what? These are futuristic in nature, but the cool part is they are regulated by a market, and the market is way more stable. So there are standardized contracts, the contracts which are basically same for all. In terms of forwards, they are customizable. They can be customized. Okay, that's the difference between these futures and forwards. Okay. So when we talk about forwards, in this case, it cannot be customized, while the forwards can be customized. Done. Then what's the next part, everyone? When we talk about the market determined prices, the prices are determined by the market, because if the market has faith in your company, they will put more money at stake. If they have if the organization has a a specific area where they need it in future, then they would try to lock in a price in advance. कि अच्छा 28 rupees, 30 rupees, $1, $2, how much of dollars you need after a certain period of time. है ना? Done. So that is how we define the specific area of. Okay, now let's talk about this further, everyone. When we talk about the futures and forwards, what's the difference? Futures are basically the contracts which are futuristic in nature, but in this case, they are standardized. They are not customizable. Regulatory market looks at it, and there is a margin requirement as well. You have to prove that you are good enough that you can handle these particular things. Then, while in terms of forwards, it is over the counter trading, though both the parties will sit and look into the contract and see whether they want the contract or not. That particular part is covered in this area, everyone. ठीक है ना? So when we define the specific area altogether, in this case, one clarity is definitely there, that in terms of forwards, there is a customization which is possible, while in terms of futures, it cannot be customized. That means it is from the regular market, and but there's one particular truth, that it is basically safer. ठीक है? In terms of futures, the counterparty risk at least doesn't really arise. There is no point where one party can make a default out of anything, right? Now that's one particular important area as well. And then comes options. Under options, it is not compulsory to buy something. You have the call option or the put option. Call option is with the company. It has the right to call other people whenever they feel that whenever they feel that they're overwhelmed with a particular situation and they would like to sell off their derivatives, or they want to give away their liabilities. So when they are trying to diminishing their to diminish or completely pay off their liabilities, then they are looking forward towards call option, calling people and then asking them if it is fine that if they repay. The second one is that the organization look forward to put option. It is not the option of the completely the buyer here. In this case, the point goes to the seller. When we talk about put option, in this case, the buyer the right to sell an underlying asset at a specified price. Right? So when we talk about the specific area of put option, call option is with the company, put option is with the investor, that he is supposed to pay this money. So this is giving the buyer the right to sell, while this gives the seller, the company. This is company gets the right to call people if they want to get paid off, and put option is with the investor if he wants his money back before time. That's the difference between the options there. In this case, this is not a obligation but a right. If you want to get it done, then you can. That is how we define it. Right? That's it for the day, everyone. Here we have talked about derivatives today and its types. Thank you. We'll be meeting in the next session.